So we're going to jump right in. We're still in economics and government and how it interacts with economics here. So let's jump right into government intervention. When the government starts doing more than just protecting private property rights in the economy, it causes problems. It's like a referee of a basketball game making baskets for the other team, or only calling fouls on one team. It messes up the game. The referee needs to be impartial and only enforce the rules of the game. Sometimes the government does things for a good reason, but they don't realize how they are messing up the game. It's like when you get in a pool. The water is going to move around and the water level will rise. You can't get in the pool without causing a change in the water. It's the same way with the government and economics. The government will cause a change in the economy if it gets involved. Unintended consequences. These changes in the economy are called distortions and are unintended consequences. So when that water is moving around, those are unintended consequences. These are distortions. The government did one thing, but they really caused other things to happen they didn't intend to cause. And James, I remember at one point you shared a little bit about in your industry how various regulations and various price controls or one thing or another distorted your industry. And we've had people in other classes share about how in their own jobs, how the government would say they were looking out for someone, pass some sort of law or regulation. Next thing you know, it had the opposite effect. That person didn't have a job or whatever it was, they caused a negative unintended consequence. Price controls. Price controls are a great example of government intervention into the market. They cause distortions and unintended consequences. Price ceilings and price floors. These are two kinds of price controls. A price ceiling means you can't sell something for more than a certain price. So whatever it is, there's a ceiling. The government says you can't sell whatever it is for more than a certain price. A price floor, the government says you can't sell something for less than a certain price. So those are two various kinds of price controls. A price ceiling causes a shortage, too little. A price floor causes a surplus. I'll explain that in a moment. If you have to sell something for too cheap a price, more people are going to buy it than normal. It's all gone. You have a shortage. If you have to sell something for too expensive a price, not as many people will buy it as normal. It's sitting around. You have a surplus. Let's examine this using automobiles. So what would happen if the government sets a price ceiling for selling a Corvette at $20,000? So brand new Corvette, $20,000. Let's just say a politician comes out and he says, I care about Americans. Every American deserves a college education, a home, and a Corvette in their garage. Boy, people would vote for him. People would just get real excited. They'd look at that Corvette and say, yeah, that looks like an American thing to me. And the government would say, and I care about the little guy so much that I'm going to prohibit Corvette from selling any of their vehicles, any Corvettes, for more than $20,000. That way every middle-class family can own a Corvette. Well, let's just say it costs $30,000 to make a Corvette, but they're forced to sell it at $20,000. Well, that first run where they're already made, they're going like that. Next thing you know, everyone's running around in a Corvette, and they only paid $20,000 for it, and they're all out, they're all gone. And Chevrolet starts looking at their accounting and says, should we make any more of these? Well, it cost us $30,000 to make one. They're forcing us to sell it at $20,000. We're losing $10,000 on every Corvette we sell. So any rational human being is going to say, we're not making any more Corvettes because we can't. So the government says we think it's an American right to have a Corvette in every garage. They set a price ceiling. Next thing you know, everyone goes out and buys a Corvette. GM or Chevrolet doesn't make any more, and they're all gone. So now you have a shortage of Corvettes. Whereas otherwise they would have sold them for $50,000, $60,000, whatever it is that the price in the market is, and they would have made them all day long if they can make a profit. So price ceilings cause shortages. Now, let's just say that that same politician, maybe in his district they make Ford Tauruses. He's in a Ford district. And he goes to that plant and he tells those guys, I care about you. I care about you and your family, and we believe that you should get a fair wage. We believe that every American should pay no less than $50,000 for a Ford Taurus. And all the guys on the floor said, yeah, yeah, and everyone, making these Tauruses say, yeah, yeah. So he passes a law, and he creates a price floor for a Ford Taurus. Now this is an older one. I know that a newer one might look nicer. But now you can't buy one for less than $50,000. Who's going out and buying a Ford Taurus for $50,000?
Not me.
Not me. That's right. So next thing you know, you've got a whole bunch of Ford Tauruses sitting in the parking lots. And you can't sell them. Now you may have someone that would say, I'd love to pay $13,000 for that car. Maybe they are in fact that middle class family, that lower class family doesn't have a lot of money. And they say, boy, I'd love to have that Ford Taurus, but all I've got is $13,000. Can they buy one? No. The car dealer would love to sell them one. They've got them sitting on the lots all across the country. But they can't do it because some politician said they cared about Ford Taurus manufacturers. And now you've got a surplus of Ford Tauruses. Price ceilings, like that Corvette, cause shortages. Price floors cause surpluses, and a myriad of other unintended consequences. The minimum wage law. Now this is one, just like a few weeks ago when we talked about price gouging. It's a hurricane, it's a natural disaster, everyone gets really upset about rising the price of gasoline, or about raising the price of a generator. They say, I need this thing. Why are you going to raise the price? It's a crisis. So it's very easy to get caught up in these things emotionally. Well, the minimum wage law is another one. We think about the single mother with 2 or 3 children, and she's taking your order in the drive-thru at McDonald's, and you say, well, she can't live on $7.50 an hour. She's got kids to feed. She's got rent to pay. Or you think about the person flipping the burgers in the back. You say, that's not a living wage. He's a father. He's got to take care of his family. Well, so what does a politician do? In fact, has anyone heard what the recent minimum wage protesters are saying they want their pay to be?
15, yeah.
15 an hour.
Yeah.
And you can actually see them protesting in the streets, 15. So they think 15 an hour will do it. $15 an hour will allow me to continue flipping burgers or taking people's order in the drive-thru window, and that'll take care of myself. Well, the minimum wage is a price control. Now, just like the law of gravity, you can go anywhere in the world and you can drop something, it's going to fall. Just like these laws of economics. You can't suspend a law just because it's an emotional issue. So, the minimum wage law says you can't pay a worker less than a certain amount. What is that? It's a price floor. Yeah. It says you can't pay less than this amount. So think about the Ford Taurus for $50,000. Is a Ford Taurus worth $50,000? No, it's not. It might be worth 15 or maybe 20 tops. Well, it's the same thing. So the government minimum wage law is a price floor. A wage is the price of hiring a worker. A worker is the product for sale in this case. If the wage is a price and the worker is the product, there's a price floor on that product. What's going to happen?
Surplus.
A surplus, that's right. You're going to have a surplus.
Of people.
Of people. Now what do we call that?
Unemployment.
Unemployment, exactly. So you've got a politician that gets involved and he says, I care about those low income workers and I'm going to do something for them. And next thing you know, what did he do? Put them out of a job. And now they go on unemployment insurance, or now they go on welfare or food stamps. Well, just like you said, we're going to have a surplus. The laws of economics don't change just because it's an emotional issue. You have to be strict with your economic interpretation to get these things right. You're going to have more workers sitting around not working than you would have normally without the government intervention. So the minimum wage laws cause unemployment. Now, remember the water analogy. If you have someone run and jump in the water, you're going to displace water. And water's going to go everywhere. Or if you just throw a pebble in the water, you're going to have the ripples. Those ripples are the unintended consequences or the distortions. Something is changing in that market. So let's talk about McDonald's. Okay, because they're protesting for $15 an hour. Right now it's $7.25 federal minimum wage. So let's just say that a worker is going to go in, and maybe this worker is going to just clean up trash. And maybe for the business owner, this amounts to about $5 worth of productivity an hour. That's what this worker is worth to the owner. But it's $7.25 minimum wage. So every hour, that owner has got to make up $2.25 that he's losing on that worker. So you've got $225 worth of distortion. Make sense? Mm-hmm. Now, you can't just expect to get in the water and have the water not move. Something's going to happen. So either that business owner is going to what? Well, what are some options you think could be the ripple effects with that $2.25 an hour? What are the options?
Raise prices.
Raise the prices on the food. Exactly. So he says, I've got to make up $2.25 an hour. So raise prices on the food. Next thing you know, we're taking that. Every dollar or every burger is more expensive. Now, what's another thing?
What we see in the store, the packages are getting smaller.
That's right. So you can either raise prices, and now you're less competitive, or you give them less of a product. So once again, the public, the general public, the consumer, is paying for it. What's another possibility?
Well, you saw like at Chick-fil-A, they used, not the one in Short Pump, but some of them used to have all these condiments out. Now they're giving you one at the counter.
There you go. So you can simply reduce the service. Exactly. But you've got to make it up somewhere. You can't just expect for a business owner just to take it. He's going to have to absorb that cost somewhere or transfer the cost. Or if he adds it all up, just like that landlord, at some point he says, it's not worth it. I'm literally not making enough money to pay for the operation. I'm out of here. So one way or another, you can't expect for the government to intervene in the market and expect everything just to stay the same. Something is going to change. Something is going to give. And it usually is not what we would like. In many cases, they simply hire less workers and give that job that would have been, given to the $5 an hour worker. They added on to the job that the $7.25 an hour. So now he's doing the work of 2 people, or 1.5 people, or whatever it is. And I'm sure that guy that would have been just sweeping, if that person has no other skills, I'm sure they would have rather just been having some sort of job in the dignity of working and bringing home some money, learning some responsible skills. That would have been better for him and better for society than to have just put him out of work or to put him on food stamps or welfare or whatever it may be. So the government intervenes in the market. It causes a distortion. It changes things. It intended to help workers by guaranteeing them a certain wage. The unintended consequence is that less people are hired and more people are without work. This is a perfect example of why the government should laissez-faire, which is our French word, which means
Leave it alone.
leave it alone. Let it be. When the government intervenes in the market, it messes things up. Welfare. Government welfare is giving money to people because they're poor. Working taxpayers pay for this. Basically, if you're poor because you don't work, the government gives you money from other people who work. Benjamin Franklin said, "I'm for doing good to the poor, but I think the best way of doing good to the poor is not making them easy in poverty, but leading or driving them out of it. I observed that the more public provisions were made for the poor, the less they provided for themselves, and of course became poorer. And on the contrary, the less was done for them, the more they did for themselves. and became richer. Sounds like Ronald Reagan. Or it sounds like the Bible. For even when we were with you, we would give you this command. If anyone is not willing to work, let him not eat.
That's not philosophy.
That's right. 2 Thessalonians 3:10. Another quick tidbit about welfare and government intervention is a simple principle, and it's not a slide, but it should be. But it's the principle that you get less of what you tax, and you get more of what you pay for, or subsidize. So in other words, if a politician wants to cut down on smoking, tobacco use, they raise the excise taxes, or what they call the sin taxes. Their idea is to make a pack of cigarettes so expensive, people have to buy less of them. So it's a little bit of a manipulation there. But even the politician in that case knows that you get less of what you tax. So if you put a tax on high incomes, at some point you get less high incomes. Because people say, well, if I move up in a bracket, they take more of my money. So whatever you tax, you get less of. Whatever you pay for or subsidize, you get more of. So if the government says we will subsidize you to raise corn, well, next thing you know, you've got a whole bunch more corn farmers. Or we will subsidize you for raising this product or that product. Sometimes they even say we will pay you to not grow a product. Specialization. At George Mason University, one of my favorite professors ever, Professor Rustisi, gave us a phrase that we should all memorize, which is, do what you do best and trade for the rest. Essentially, in our kind of economy, if you remember the pencil analogy, the pencil story, the argument was made that no one person in this room or in the world can make a pencil, because there are so many different steps to making a pencil. You've got someone up in northwestern America that is a logger, and they've spent their whole life learning how to just saw down a tree perfectly and how to engage in that process. You've got a commercial driver's license individual that's driving the big rig across the highways, and they're really good at that, and they know how to move those big rigs. And you've got someone somewhere else learning how to produce the lacquer, and then you got somewhere else. Basically all these multitude of processes which each person has had to learn to do throughout a period of their life, and that for one person to try and do all of them to make a pencil, you might be 100 years old and maybe at some point possibly make a pencil on your own. Probably not. The way we achieve all these processes going on at once is through specialization. So one person learns how to do one task very, very well, just like in the Ford Motor Company assembly line. They just have these things going through there, and someone would get a part, they would do that one thing to the part, and they'd send it on. And that's, of course, how we mass-produce vehicles, is specialization. So this is also just good for life. In other words, I may be good at teaching, but don't ask me to fix your car. If I see someone on the side of the road with their hood up, I say, I'm sorry, buddy, I don't know what your problem is. I don't know. I can't help you. So there are people that have specialized in law or specialized in large industries with financial implications, and they're nurses and things that probably a lot of us shouldn't really even try. Doesn't mean you couldn't learn to do something. It means that someone else has spent a lifetime learning a skill. So in this market, what we do, in this economy, what we do is we do what we do best and we trade for the rest. Government regulations. Some regulations can be helpful, but each regulation will come with a cost to those who impose it and to those who have to live by it. Many regulations can be destructive and have unintended consequences, so be very careful. So for instance, every regulation that the government creates, they also have to create a bureau or an agency or a task force or some sort of entity to regulate it, to make sure that that regulation is being followed and to enforce it, etc. So you have a cost there, but also you have a cost on the part of those who have to comply with that regulation. For instance, at the school, Salem Christian School, Todd was telling us about the light bulbs. That at a certain point, some bureaucrat regulator somewhere decided that Americans should not own and use a certain kind of light bulb anymore. So they said on this date you can no longer sell it or purchase it, whatever it may be. So Todd, the principal, knew this, and the whole school is fitted with these light bulbs that are at some point were going to become outdated. So he went out and bought a whole bunch of light bulbs, as many as he could find and as many as he could purchase at the time, because he knew that when all these light bulbs ran out, not only would he have to buy the new ones, but he would have to change the fixtures throughout the whole school. And that's a cost. And that's just one regulation in a midst of thousands and thousands and thousands of regulations. So why some regulator, some bureaucrat somewhere thought that we shouldn't have a certain kind of light bulb, it beats me. But the point is that I'm sure they've got a light bulb bureau somewhere, someone making sure that people are compliant. And now you've got a principal of a small Christian school in between a cow pasture and a cornfield having to replace all of his fixtures in his school one day. And that school, like many private Christian schools, they don't have a lot of extra money laying around for a whole lot of excess expenses. So that just goes to show every regulation has a cost to those who enforce it and to those who have to follow it. My favorite economist, Henry Hazlitt. This is a book that everyone can and should read. It's very easy to understand. It's called Economics in One Lesson. The shortest and surest way to understand basic economics. Wonderful book. In Economics in One Lesson, Henry Hazlitt said that lawmakers have to make every law based on its long-term effects and not just the short-term effects. So in other words, when they were thinking about Social Security back, 70, 80 years ago, they said this will just be a short-term stopgap measure. They said, don't worry, it won't get out of hand. We won't even have this for very long. Oh, and they said, by the way, we're not going to use your Social Security number as identification. Don't worry, this will just be used for this very, very small purpose, and then we'll end it. And of course, now we know that your Social Security number is your most protected identification number. And we also know that the Social Security account or reserve is empty. That there's no money there. They just didn't think long term to think that at some point you'd have more people taking out than putting in. In other words, they thought short term and not long term. And in almost every poor policy, you can find some sort of short term limited thinking rather than long term thinking. And this is also helpful in life, by the way, too. Henry Hazlitt also said that lawmakers need to look at the effects of any law not just on some groups, but on all groups. So in other words, don't just find a little pet group that you're going to cater to, whether it be women, whether it be minorities, whoever the politician is trying to manipulate on that day. Don't do that. Pass laws that are good for all the people and not just a minority, not just a special interest. So think long term, not just short term. Think about all groups and not just some groups. And that was what Henry Hazlitt said is the difference between a good lawmaker and a bad lawmaker. First, second, and third party purchases. This is very important. A first party purchase. When you buy something for yourself with your own money, this is a first party purchase. In this case, you care about how much money is spent because it's yours. And you care about the quality of the product being purchased because you're going to consume it. In this case, the quality will be high and the cost will be as low as you can get it. When you buy something for yourself with someone else's money, that's a second party purchase. You don't really care about how much money is spent because it's not your money. But you do care about the quality because you're going to consume it. So in this case, the cost, unless you're given a limit, will be as high as possible. And the quality will be as high as possible because you're consuming it, but you're not paying for it. That's a second party purchase. A third party purchase. When you buy something for somebody else with someone else's money, that is a third party purchase. You don't care about how much money is spent because it's not your money. And you don't particularly care about the quality of that product because you're not going to consume it. So the greatest, most moral person with the greatest amount of love and integrity, they'll overcome this third-party purchase some of the time. But most of the time with most people, in a third-party purchase, you get a high-cost price and a low-quality product. Because it's not your money and you're not consuming it. The government uses somebody else's money to buy things for other people. That's a third-party purchase. That explains why the government is wasteful and does a bad job oftentimes. Because they're buying things with other people's money and that they're not going to consume themselves. That doesn't mean the government is bad. The government still needs to do things. However, since you know it will always be more expensive and less quality than if private individuals did it, you restrict the government to only doing the things it needs to do and nothing more. Now, just a little tidbit with Obamacare. Okay, what are the different parties involved in Obamacare? So name the different parties involved.
Insurance company?
Okay, so you got an insurance company. Who else?
Government,
You got the government. Who else?
Physicians
You got a physician
and us.
and us,
Consumers.
consumers. That's got to be like a fourth party purchase. I mean, that's something new. Okay, so you got you and you got the doctor over here. If that's all there was, that's a first party purchase, right? You're paying for it for yourself with your own money.
And you're getting the benefits of it.
And you're getting the benefits of it, right? So that would be the first party purchase, is if there was no one else in between. When you stick an insurance company in there, well, essentially you've paid into it, but you know you're basically using a pool of money. So that's when the tests go up and you know, the procedures go up and I think we better do this, and this. And when insurance is paying for it, you don't say how much does it cost, because it's paid for. So you say, sure, run the tests. So next thing you know, the doctor's off, you know, spending tens of thousands of dollars on tests that you may or may not need. So you've got you, the insurance company, and the doctor. So you're receiving it, but you're not necessarily paying for it. You're not paying for all the costs. So the costs will increase, and you're still going to get some good quality. But now you have the government in there. So that's so complicated, I don't even know what to call that. But you can imagine that in this case, the quality will decrease because both the insurance company and the government are involved, and the doctor's over here. You know, when people say, well, how are you going to fix healthcare? Well, if you understand the principles of first, second, and third party purchases, what you understand is you want as close a relationship, first party purchase.
With the doctor.
You want it to be just like going and buying a McDonald's burger. Okay, you want it where it's your money and you're getting the benefit. And so even if I can't figure out what kind of party purchase, a seventh party purchase, or who knows what it'll end up being with Obamacare, government-run health care, the point is that you've gotten farther away than that first party purchase rather than closer. So we can do the math some other time. It's too complicated for me to figure out right now. But the point is we need to understand first, second, and third party purchases and what that does to price and to quality. In this vein of economics, the limited government free market vein of economics, there are two acceptable views of tax policy. The first is the purpose of tax policy is to pay for the essential functions of the government. That's it. Now, another goal is to only tax what you need to do this, and you negatively affect productivity as little as possible. So in other words, figure out how much it costs, only take the taxes to pay for those things, and don't hurt productive people. In other words, don't get in the way. Don't mess it up too much. Mess it up as little as possible. So that's the first one. The second one is slightly different. The second one is the purpose of tax policy is to get as much revenue as possible while still negatively affecting productivity as little as possible. So do you see the difference there? In the one case, you say, all right, how much does it take to have the best military in the world? Okay, it's going to take this much per year, so that's there. Well, how much does it take to run our judiciary system? Okay, it takes this much. Well, how much does it take, et cetera, et cetera. So you figure out what the essential function of the government is. You figure out what it will cost to run it adequately, at high quality, per year. And you say, this is how much we need, this number. And then you figure out how to get it. That's one way to do it, is simply pay for the essential functions of the government, only tax that much. The second one is not based on what the functions of the government are, but let's get as much as possible, as much revenue as possible in. This second purpose, or option of a purpose, is only acceptable because of the second part, the clause, which says you still don't hurt the economy as much as possible. So you affect productivity as little as possible. Either way, pay for the government and don't mess things up. That's good tax policy. Now, just let me explain what we talk about when we say negatively affect productivity as little as possible. So not all taxes are the same. We need taxes to run a government, that's obvious. For instance, do we remember the 39.1%? What is that? Do we remember at the beginning of our class? What is 39.1% tax? And America is the best in the world at it, the highest in the world at it.
Is that the corporate tax?
Yes. So America has a 39.1% corporate income tax rate. So that is the highest in the entire developed world. Okay? So that means we are the least productive or the least competitive in the whole world in that category. So that would be a harmful tax. Every tax is going to take something away, but you have some taxes that are less or more harmful towards productivity. So if you're trying to encourage a productive economy, one of the first things you would do is you'd get rid of that high corporate tax rate. And that way money can come in. Jobs can be created here rather than in every other country in the world that has a lower rate. Capital gains taxes. So you sell a home, you make some money, you're taxed on it. Or you make an investment in the stock market, you make some money because that stock did well, you're taxed on it. That's a capital gains tax. They also call that the unearned tax, but I don't think that's fair. But essentially it's a tax on capital gains. Well, that is a very, very unproductive tax. Because if you are investing in the stock market, investing in a company, that's fueling productivity somewhere else. That's giving someone else a job. That is fueling innovation and invention, etc. Or when you sell your home, if that is an investment home, well, you just help someone else get a home. You just help productivity. In other words, you did something useful and good. So another very harmful tax is capital gains tax, because it is that kind of tax which fuels productivity. Okay? Now there are other taxes that are less harmful. Okay? Because remember, you get less of what you tax, you get more of what you pay for, right? For instance, the graduated income tax rate, so that the richer you get, the more you get taxed, that's a very unproductive tax. What does it mean? You get less of what you tax? That means you get less high earners. That means you get less people being productive and making money and serving the community. Someone says, well, if I make $1,000 more a year, they're going to tax me that much more. Well, I'm not going to do it. I could be more productive. I could do this next thing. I could work harder or, do whatever it is more, but I'm not going to do it. So you get less of what you tax. So next thing you know, you get less people rising up to that level and rising to the next level of productivity. So once again, a graduated or progressive income tax rate is rather harmful because it hurts the people that are trying to be the most productive. And it actually incentivizes being at the bottom. Because if you're at the bottom, well, you don't really get taxed. In fact, you get a rebate, you get a return. So you're getting more of what you don't want, which is people at that lower level, and less of what you do want. Now, what's a tax that is less harmful? The sales tax, for instance. Because the sales tax, number one, is a voluntary tax. If you don't want to be taxed that day, don't buy something. I mean, really. It's also a flat tax because everyone's taxed the same. It doesn't tax the productive person more, and it doesn't subsidize or give something special to the person who's less productive. So while we don't like the idea of paying more for products or services, it really is one of the the least harmful taxes you can have. It's flat, it affects everyone the same, and actually, in a good productive economy, you want people to save money and not to just go out in debt and be spending. So in fact, it will encourage thrifty behavior and saving, which is what you want in a productive, solid economy, and it doesn't hurt production. In other words, yes, every tax is going to hurt somewhere, but the sales tax is an example of something that is the least harmful to the economy. So when you say negatively affect productivity as little as possible, that's what it's talking about, is pick taxes, have taxes that don't hurt your economy, like that capital gains tax or your corporate income tax rate. But either way, pay for the government and don't mess things up.